Hi, my name is Rain, founder of Forex Academy Private Limited. Many of times, new traders, they are confused on when I purchase a standard contract, when I buy a lot, how much am I buying? Well, currency trading is not like other financial product like stocks, how many shares you own and stuff like that. In Forex trading, we are earning the difference of the exchange. So take for example, okay, let us move back to the whiteboard. Take for example, if you are looking to if you have analyzed the news, you have seen that pound in particular, all right, GBP has a potential of appreciation, or you are looking at USD has a potential of depreciation. This is just an example, all right. So with this, a sound way for you to trade is to look at pound dollar, all right, and you would like to go long, all right. So with this, then you have to look at your capital, like how much you are trading or how much you have. Um, but in our teaching, before you even engage a trade, you have to see how many pips of losses you are okay to expose with. So what is a pip? Okay, so let me just go back to this. A currency movement, let's say for pound dollar, take for example 1.2300. When it moved to 1.2301, the fourth decimal place movement is considered as one pip movement. All right, and in forex trading, a standard contract, we call it a one lot trading, okay, will equivalent to 10 USD per pip movement. Or you can also say that you can understand in this way that one pip movement will be 10 USD per lot. Everyone clear on this part? Okay, so in trading itself, you have to analyze where do you put your stop loss, where do you put your take profit, and where is your entry price. So these are the three things that you have to consider. So what is an entry price? Entry price is something, is a price that you enter the market. Okay, so in the trading itself, you can either long, or you can understand as buy, or short the currency value itself. All right, the currency pair against the other pair. So you choose to buy or sell. Very simple. Okay, so when the market goes south, when the market move against you, you have to cut loss at some point, you know. So when you cut loss, it is known as a stop loss. You can preset the price in. Take for example, you choose the long pound dollar at 1.2300. You have analyzed the market and you are going to cut your losses at 1.2250. Take note, it's a 50 pip stop loss. So you can enter your stop loss as 1.2250 when you're trading. Okay, and if the market goes south, it go against you, it hit 1.2250, your cut loss, even it went to 1.2200, 1.2000, you're not going to lose more than what you have set. All right, so that is stop loss. Take profit is the level for you to exit the trade with a profit. Meaning you say that when it reach your price target, you have analyzed that was the previous high, you want to exit at that particular price, you can select a, you can enter a take profit value. Let's say you put your take profit at 1.2400, where previously your entry price is 1.2300, that will bring you to 100 pips of profit. So when the market have reached 1.2400, the system, the broker, will actually exit at the price that you have set. Alright, so this will bring me to ask you guys a very simple question. So in trading itself, a lot of times traders love to look at the upside, meaning say that the profits and everything you like. We all do, correct? But in trading, I view it like a business. When you engage a trade, you engage a business deal, you will not be risking your entire business capital. Am I right to say so? So likewise for every trade, when you're about to engage, you are definitely comfortable and confident that it will be a profitable one. If not, you are not going to enter the trade. Make sense? Alright, so even though we are very confident that the market is going to appreciate or depreciate, through the analysis we have done, we are not going to risk entire capital for one single trade. If not, there will be gambling. So you have to ask yourself, if you are trading a standard contract, okay, one standard contract itself, one lot, your initial risk, we call it initial stop loss, is 50 pips. And 50 pips multiplied by one standard contract that you are trading over here, alright, multiplied by 10 USD per pip movement, that will bring you to 500 USD losses if the market go against you. However, if the market hit your take profit level, you earn 1,000. Everyone is fine with 1,000, additional 1,000 in your pocket, but you have to ask yourself, are you okay to lose $500 in a single trade? You can decide that based on your personal risk acceptance, or you can decide that through how many percentage of the entire account you're going to risk. Okay, so 50 pips, remember that we are going to use a calculator to help you with that. So let's say your capital is 10,000 USD. And if you're trading with a $500 loss, that will bring you to a 5% losses. And of course, if you make a profit of 1,000, okay, if you make a profit of 1,000 USD, that will bring you your account to make a profit of 10%. You have asked yourself, is it okay with you? And of course, if your account size is 1,000, and if you are trading a standard lot itself, and one standard lot 50 pips of losses, 500 USD, you have to ask yourself, are you okay to accept a risk of 50% drawdown in a single trade? And of course, everyone will love an outcome of 1,000 USD profit. So my point is, you shouldn't, some of you might be thinking right now, oh, then I should have put a lesser stop loss and stuff like that. A lot of people will compromise the stop loss itself, and stop loss or take profit level, it has always to be set in a way that it makes sense to the market, in a way that it has to be a structure, meaning to say that support or resistance, in layman term, previous high or previous low. You cannot say that, oh, I'm only going to risk $200 or $100, I'm going to put a 10 pip stop loss. Then you'll find that most of the time you'll get stop out. Alright, so that's one thing. Okay, so stop loss and take profit, you have to use a structure and not of your liking. That's why we have to analyze whether there is a good reward is to risk ratio profile, which I'm not going to touch on in this video, if not it'll be too long. Alright, so you have to ask yourself that, and how many percentage of risk you're going to take in a single trade based on your entire account size. So with that, I have a calculator to help you with. Alright, so let us just switch to the calculator. So for all my viewers, you get to have this free access to this website itself is www.forex100academy.com. okay, so you can click the tools itself. If you do not have an account, you will have to register. Alright, so this calculator, there are two calculators over here, one on the left side, the other one on the right side. So let's say a lot of traders, they enter the trade and they say that, oh, my capital is 10,000, I'm looking to trade 3 lots, let's say, and my stop loss is around 50 pips. So they will actually engage the market just by trading 3 lots over here. Okay, this is contract size, the volume. Okay, 3 lots over here, and they blindly enter the trade, not knowing what will that bring them to. Okay, so after they enter the trade, they realize that it hit the losses 50 pips and say, whoa, I make a huge loss. You know, I burst my account and stuff like that. Okay, so let us take a look. A trader like that, how much they're actually risking? They're risking 15%, 1/5 of their initial trading capital. Are you fine with that? Another way that I will urge you guys to explore is that you do your market analysis. Let's say you analyze the market. The risk you have to take for the stop loss you have to take is 50 pips. The risk you're okay to take maybe is 2%. Okay, and of course you need to have some KPI, key performance index, to share with you, your analysis to share with you what kind of trade you're going to risk 1%, what kind of trade you're going to risk 2%, so on and so forth. So the system will actually analyze, or rather calculate for you, based on $10,000, you're going to risk 2% of it, which is $200. You're okay to lose $200 for this trade, okay, or if it went against you, okay. And the stop loss you have to set is 50 pips. The system will tell you, oh, why not you are going to engage a 0.4. Alright, why not you're going to engage a 0.4. So when you enter a trade over here, instead of 1 lot, 2 lot, or 0.5, you key in 0.4 and you engage your trade. So even the trade goes south, you know that your downside is $100. It's manageable for you. Your upside, a good reference should be at least $200. Alright, so you know every trade you're making, let's say, a loss of 100, and every winning trade you're making a loss of 200. In the long run, you keep it that way, you'll be very profitable for yourself. Okay, so let us just do an analysis, a simple one. Okay, the market have, based on 15-minute time frame for pound dollar, it have broke previous structure high, it went higher, came back down, right now it's retest. So this is what we call a support level, or rather a recent support level. Alright, so as you can see, the recent support level is seen at 1.2419. I will not be placing my stop loss at this price. I will place at least 25 pips below the support level. Okay, so if I'm going to place 25 pips below, that will bring me to what price? Okay, so if you don't have a calculator, that's a trick. Click a crosshair, it looks something like this. Alright, click and drag 25 pips below. So it bring you to 1.2394. Okay, so 1.2394. Okay, some of the trader might want to put a horizontal line 1.2394. So you know that this is your stop loss level. So where is your take profit level? The first level of consideration is definitely, okay, let's say you're going to engage, it will be here lah. Okay, definitely over here, 1.2463. So having a stop loss of 40, close to 40 pips, and a profit of the first target level of 30 pips, is it a good trade? It is not a good trade. Alright, so but this is just for demonstration purposes. This is a demo account. Okay, so I can walk you guys through on how to use the calculator. So let's say your stop loss has to be 40 pips thereabout. Okay, so just key in over here 40 pips. And let's say you're not that comfortable to risk 2%, you're looking at 1.5% or 1% of the trade itself, you are only able to trade 0.25. Okay, so if you get stop out, you only lose $100.